2008, while the world's biggest banks were collapsing, one man calmly told his sons a secret. It's all one big lie. For decades, he had been making money every single month. Up markets, down markets, crashes, booms, always steady, always smooth. His name was Bernie Madoff, and he ran the largest Ponzi scheme in history. $65 billion on paper, about $18 billion in real cash, gone. This isn't just a story about greed, it's a story about trust and how easily it can be engineered. Because Madoff didn't look like a criminal, he looked like Wall Street royalty. He was the former chairman of NASDAQ. He advised regulators. He was the guy institutions trusted. If you wanted safe, consistent returns without drama, you went to Bernie. And that's what made it work. Here's the promise. Madoff told investors he used a split-strike conversion strategy. It sounded technical, sophisticated, almost boring. In simple terms, he claimed he bought big, stable stocks, hedged them with options, and produced steady gains with limited risk. And the numbers were magical. About 10 to 12% per year. Not 30%, not 50%, nothing outrageous, just smooth, dependable growth. That was the genius. Real investing is messy. Markets swing, portfolios fluctuate. But Madoff's returns barely moved. Month after month, a gentle upward slope. It felt safe. Too safe. Here's the uncomfortable truth. There was no strategy, no massive options trades, no secret algorithm. When investors gave him money, he didn't invest it. He put it in a bank account. When someone wanted to withdraw profits, he used new investors' money to pay them. That's it. A classic Ponzi scheme, named for Charles Ponzi a century earlier. Old trick, new scale. The illusion worked because money kept flowing in. Wealthy families, hedge funds, charities, university endowments. Some investors even begged to get in. Madoff created artificial exclusivity. You couldn't just walk in with cash, you had to be invited. And humans interpret exclusivity as safety. Irony number one, the harder it was to invest, the less people questioned it. But how did no one notice? There were red flags everywhere. His returns were too consistent. His auditing firm was a tiny three-person shop in a strip mall. His strategy volume didn't match real options market data. One financial analyst, Harry Markopolos, spent years telling regulators it was mathematically impossible. He was ignored. Why? Because Madoff wasn't just selling returns, he was selling comfort. He spoke calmly, he dressed conservatively, he never chased headlines. In a world of flashy traders, he looked responsible. And institutions trusted reputation more than math. Let's talk about the math. A Ponzi scheme survives on growth. If investors collectively want to withdraw more money than new investors bring in, the system collapses. As long as confidence grows, the lie survives. But in 2008, the global financial crisis hit. Markets crashed. Investors panicked. They wanted their cash back. Suddenly, withdrawal requests flooded in, billions of dollars. Madoff didn't have it, because it never existed. Within days, the machine stopped. The illusion cracked. He confessed to his sons. They called the authorities. He was arrested the next morning. When investigators looked inside, they found decades of fake account statements, fabricated trades, imaginary profits. The reported $65 billion was mostly paper gains, numbers typed into statements, wealth that felt real until someone tried to spend it. Charities shut down, retirement accounts evaporated, lives were destroyed. And here's the uncomfortable part. Most of the victims weren't reckless gamblers chasing wild returns. They were conservative investors looking for stability. That's what makes this story relevant right now, because the most dangerous frauds don't promise the moon, they promise consistency. Steady yield, low volatility, exclusive access, a strategy too complex to question, but too smooth to doubt. The psychology hasn't changed. When returns look boring but perfect, we relax. When everyone around us seems confident, we outsource our skepticism. Madoff understood something simple. People don't just want profits, they want certainty. And certainty is expensive. Zoom out. How did this last for decades under regulators' noses? Partly because oversight systems assume basic honesty. They check boxes, they review filings, they don't expect a respected industry insider to fabricate everything. Trust is efficient, but it's also exploitable. In the end, Madoff was sentenced to 150 years in prison. He died there in 2021. But prison time doesn't recover trust. The real damage wasn't just financial, it was psychological. If someone that established, that regulated, that integrated into the financial elite could fake everything, what does safe even mean? Here's the quiet irony. His returns were so stable that they became unbelievable, only after the collapse. Before that, stability was proof of